Hello and welcome to our webinar. We are going to be talking to Bill Cook in just a second. He's going to talk about and sort of preview his upcoming class on options. So this is going to be a great webinar because Bill often talks about using smaller amounts of cash to get invested. And of course, when you're talking about an IRA, a lot of times we all sort of think about making bigger purchases. So doing private mortgages, or maybe buying real estate, but how can you get invested with a smaller amount of money? And although sometimes options involve more money, Bill does often talk about using smaller amounts of cash to get invested. And so I look forward to having Bill talk about that in just a moment. My name is Larissa Greene. I'm with Advanta IRA, and I just wanted to give you guys on the call today a little bit of information about Advanta before we get started. I've been with Advanta IRA for over 10 years now. I started out in the transaction side of Advanta, where I was helping with check coding, new accounts, doing transactions for clients, and even billing for Advanta IRA. And so I've sort of done a little bit of everything in the business. And then probably about 8 years ago, I moved over to business development and marketing, and that's where I've been ever since. So many of you on the call may know me from attending classes and different networking events, and it's been a lot of fun for me doing that, and I will continue to do so. So I look forward very much to Bill and Kim's upcoming class, and that will be May 21st and 22nd. So we're just a week and a half away really until that class. A little bit about Advanta. We are a self-directed IRA firm. We hold a few other accounts, which I'll talk about in just a second, but we've been doing this for almost 20 years, and we have $2 billion in assets under management. We've really grown in the time that I've been with Advanta. We are in the Largo or Tampa Bay area of Florida, and we also have an office in Atlanta, Georgia. But really, we can help anybody anywhere. So if you're thinking about self-directing your IRA, your 401k, your HSA, or your ESA, we can help you with that. And as you guys know, almost everything is done these days over DocuSign, for example. So we can help you with that, or by fax or email. And so business really can be anywhere, and you can invest just about anywhere. So we have a lot of webinars. We talk about the rules for investing through an IRA, and we also talk about the different asset classes that we see on a regular basis. We won't be talking about that today, but if you're interested, please feel free to reach out to me, and I can definitely send you some webinars on those different topics. You can also check out our YouTube channel. Just search Advanta IRA, and you will find those topics. And for example, I just did one last week with my associate Corey, where we talked about the more unique investments we see in an IRA. So things like farm animals and transportation. We also see leases on land for things like hunting and timber rights. So if you're interested in learning more about that, again, you can check it out on advantaira.com. And you can also go to our YouTube channel and search Advanta IRA. We often talk about the investment structures that we see in a retirement account, but what we can't do is provide investment, legal, or tax advice for you. If you have questions that you're really just not sure if it's something we can answer, you can ask me anyway, and I may be able to refer you to a professional that can help you with those questions. But just keep that in mind as we go through different webinars or as you review our content online. We can't tell you, okay, well, this is a good investment or the return is a good return. We're not going to answer those types of questions, but certainly you can check in with your CPA or your attorney. And like I said, I can certainly refer you over to those individuals that might be able to assist you. So what is a self-directed retirement account? Just very simply, we hold investments that are not held within the market. So, you know, stocks, bonds, mutual funds, those are very typical for your brokerage firms. But what they don't do is hold what we consider private investments. And so we're really just filling the gap in the industry for those asset classes. And that could be anything from real estate all the way through to like cryptocurrencies. And I know you guys are probably seeing a lot of information about cryptocurrency right now. But an IRA can hold cryptocurrency as well as things like gold and silver bars and coins. And so we talk a lot about those different investments on a regular basis, and we have a lot of questions coming in on those. And of course, right now, cryptocurrency is something that a lot of people are interested in. But our more typical or more common investment, just very simply real estate. So buying and holding 123 Main Street in an IRA. We also see a lot of first, second, and third mortgages. We see wrap loans, and we also see unsecured notes. So again, do your due diligence, and if it's an investment you feel comfortable with, then it's maybe something that you can do in a retirement account. We see a lot of private placements, so private stock and limited partnerships, and again, precious metals. We also see foreign currency exchange and futures trading, and the list really does go on and on. So I would encourage you to join us for another webinar where we talk more specifically about the asset classes that we hold. I mentioned that we hold qualified funds, meaning IRAs. So if it ends in IRA, it can be self-directed. A lot of times people think that it has to be a Roth IRA. I'm not really sure where that comes from, but actually it can be a traditional IRA, which would be the most common type of account we hold. Roth, SEP, Simples, and then of course solo 401ks. We can also help you with former employer plans, health savings accounts, and education savings accounts. The rules for self-directing all of these accounts are the same, and so we're able to assist you with those. And the process for each of these accounts is very similar. So we can kind of walk you through that process. And that's all I wanted to cover very quickly today so that we could get Bill on. A couple of things before I bring Bill on that I want to mention is that we are taking questions throughout the webinar. We're not going to unmute you, but please feel free to type your questions into the chat box and we will answer them as we go. I also did add the slides for you as a handout. So if you look at your right-hand navigation, you are going to see them added as a PDF. You have the opportunity to download them from there. And with that, I'm going to bring on Bill. Bill, how are you today?
I'm doing really, really great. Thanks for having me today, Larissa. I greatly appreciate it.
Yeah, thanks for joining us.
Oh, I would love to. Just this is going to be a lot of fun. I'm starting.
I think you have control. Yep, I think you have control now.
I don't see the little clicky thing, so I may need help with the clicking. Anyway, folks, I just want to say thanks for having me here, and I also want everybody to know that Kim and I, we do have our solo 401k accounts with Roth components with Advanta. So when I teach and that brings me into teach, I use their service. They're tremendous custodians. Is who I love working with, and many of our friends, investor friends that we have, also are with Advanta. And we are here because of their great service and the great education. So there's a lot of great information. These calls are recorded. So if you're not sure how self-direct works, this is where you can go back and watch programs. And I also have my self-directed HSA account, health savings account, is also with Advanta, which again, just a great place to work. And there's very few absolute truths in life, but let me give you one. The reason why we're with Advanta is because we all love Larissa. That is an absolute truth. So
thank you, Bill.
It's said, you're welcome. So that's what's going on. And the reason why I'm here also, I just want to let y'all know ahead of time, we'll talk about this a couple times through the program, is Kim and I will be doing a program called Power of Pure Options on May 21st, 22nd. So that's coming up quickly. It'll be in Tampa. And really this program is about why you should have the options as a creative deal structuring tool in your deal structuring toolbox. Because a lot of people don't know how to use this and all the power, but you'll see just a tip of the iceberg, as they say, in this. So first thing you need to know about me and Kim is we're just a husband-wife real estate investing team. We're not a big deal. We did 12 to 15 deals a year, and we did it for more than 2 decades. So we were never rock stars. We just went out and did our deals, and most of my deals came through door knocking. Okay, next slide. Oh, I have got a clicky. I got a clicky, Larissa. So let's talk about pure options. So today, what we're going to be covering is we'll talk about what pure options are, because most people have never heard of pure options. And we're also going to talk about why they're such a unique deal structuring tool, because they allow you to help people in a way that no other tool allows. We're going to also talk about why so few investors know how to use options or use them. And then also, when the people who know how to use options, the investors who know how to use options, for the most part, they only use this tool one specific way, nowhere scratching the surface of all that this tool can do. And example is pure options allow you to buy a property that you can't possibly afford. They allow you to sell your property to someone who can't afford them, but in a way that it helps you make more profit or make a better deal. Also, it's the best tool to use when you come across a homeowner who doesn't want to sell. and you heard me right, doesn't want to sell, but maybe they need help. Maybe they're being forced to sell, but don't want to. And all you know how to do is a 70 cent on the dollar offer. That doesn't help them because they don't want to sell. And an option is a great tool that allows you to fix this problem. And an option will allow you to capture a property's appreciation even after you sold it. And you're probably sitting there scratching your head going, well, how can you profit from a house that you no longer own? And you'll see an example of that. And lastly, we'll talk about how do you secure an option. In other words, let's say you have an option to buy someone's property and then they decide not to sell it to you, or they're not making the mortgage payments, or they're not taking care of the property. What can you do then? How do you protect yourself? So you need to know my history because I stand on the shoulders of the absolute giants. And that begins with Jack Miller. I took my first Jack Miller course on options back in 1999. It took me about 2 years before I did my first option deal because I wanted to make sure I understood it. And I was unsure of what I was doing. I was unsure of where I was in the deals. And again, first class, but 2 years to go to it. But Jack Miller just was the man when it came to options. And I attended every time he would teach an options class, I went. Also, there's another man that's the best creative deal structurer out there right now. His name is Pete Fortunato. And I take all his classes. He has a class coming up in June called One Step Beyond. And when he does this, he often talks about options. So these are the two men that played the biggest role in me learning how to use options and how they work. And I can't ever thank them enough. So what is the difference between an option and a pure option? And for most people, well, let's talk about what a pure option is. It's when an option is used by itself. In other words, there's no other tools involved. You're just getting the option on the property all by itself. We call that a pure option deal. Now, what most people know about options is when you hear the phrase lease options. And most investors say it as if it's one word, lease options. They say it if it's one document, lease options. If it's one thing, lease options. And this is about all they know about options is it's always done with leases. Now, the correct term is not lease options, it's a lease with an option to buy. This means you're using two different deal structuring tools that do two completely different things. The first is the lease. The lease gives someone use of a property. It has nothing to do with the buying and selling of that property, just the use of. But the option can give someone the right to buy the property at some point in the future at a pre-agreed to price, pre-agreed to terms, a pre-agreed to time frame. So again, you have the lease that gives use and the option that gives someone the right to buy. And what we're going to be talking about today is the option segment of this structure, the tool that's going to be about how to buy. So most investors, because all they know how to do is lease options, they never even scratch the surface of all the full potential that an option gives you when it comes to deal making. And what I'm trying to do now is put light on this. Because again, Jack Miller taught us what to do. It's just that message has kind of been forgotten. And this is a great time to learn it. And here's why. You know, the market changes. It's always changing. The cheese is always moving. So as it changes, what will you do? And if you're unsure what you're going to do when you go through change, that means you're starting to take more and more chances. So if you can tell me what the real estate investing markets, or the real estate market will be like a year from now, then you're much better than I am, because none of us have the crystal ball. So in other words, we can be taking chances on the deals we're doing. And you want to eliminate chance because chance is risky. Chance will get you in trouble. So right now, is the real estate investing market changing? So you have to answer that question. And to help you along, what's happening with inflation? Is it more or less than it was a year or two ago? What about interest rates? Do you remember last year when you could get a 30-year fixed rate loan for 2.9% on an owner-occupied house? What's that? What are those interest rates today? They're over 5%. And as interest rates climb, what will this do to home values? Even in Florida, where the market's white hot, what happens as interest rates go up to 5%? What if they hit 8%? What if they hit 10%? When I started investing, they were at 12%. That was just common to pay for a bank loan. I don't mean hard money, I mean a bank loan. Now, one of the things that Jack taught us, this is one of the most important lessons. He told, this was in 2007. I was at one of his seminars, and he said, in uncertain times, when you don't know what the future holds, switch from deeds and notes to master leases and options. And let me explain what this means. Is in 2007, we weren't sure what was happening to the real estate market, but he predicted there's going to be a downturn. Something's going on here that we can't see coming. We didn't know it was going to be the Great Recession. We didn't know how bad it was going to get, but we were unsure of what was happening. And many investors, when they were buying their properties, they were getting short-term commercial bank notes. In other words, they had balloons in the notes that would be called in 1, 2, 3 years. And that was very, very common. But that also made it risky, because 3 years from now, the market was down and the bank called the note due, and you didn't have the money to pay off the note, and they weren't gonna refinance the note. What were you gonna do? Because you were gonna have to come up with all the cash. And if you had 5 houses, 10 houses, 20 houses, you were gonna have to come up with millions of dollars. And if you didn't have it, that means you were gonna lose everything. And that's exactly what happened in 2008, 2009, 2010, 2011, 2012, and we hit bottom and came out of the Great Recession in 2012, and then prices started back up again. But Jack said to us, switch from getting warranty deeds and giving promissory notes, switch to master leases and options. And when it comes to master leases, the best teacher in America is David Tilney, Tilney. You can go to davidtilney.com. I know that Advanta and Larissa have interviewed him, and you can see some of his recordings in the library that Advanta has. But David is phenomenal at teaching master leases, and that's where Kim and I learned how to do master leasing. But what Jack taught us was use master leases to be able to gain control of the use of a property, but also use options to be able to buy the house, but not now. But at some point in the future, when we were on more stable ground, when we knew what values would do, when we knew which way the market was going, when we had built up the equity over time in a house, and you'll see how to do that. But what a great lesson from Jack. Let's talk about a deal, and I want to show you how options can be used to make an impossible deal possible. Because again, for most people, they're going to only make a 70 cents on the dollar offer. That's the only way they knew to do the deal. And this was a case, it's called Cox Farm. And this was a case where the property was upside down and it had negative cash flow. So the way it was found is, that was my buddy Houston Long. So back in 2013, he's a germaphobe. So he was into Perel before Perel was cool. And we were out door knocking, and I got a call from a seller, and the seller was at wit's end. He had just evicted the tenant. He had just gotten done doing a rehab for the third time to this house, and he just wanted done. And so we went out to go take a look at the house. And as we turned onto his road, one of the things that Houston started laughing, and I said, "What's so funny?" He said, "I was here 2 weeks ago." He said, "There's no deal here. This house is upside down badly, and it has negative cash flow badly, and there's no deal here. We wasted our time." And I want you to know that the seller, the owner of this property, and I came to an accord and structured a very good deal within 30 minutes. Now remember, Houston didn't know how to use options. He wasn't sure how to do master leasing. So those tools weren't in his toolbox. So he walked past this deal. Kim and I did this deal, and I want you to see what the result was. So what you're looking at now is called a TBar. And with a TBar, this is the most important document I use in a house. When I'm sitting down talking to a seller or a buyer or a lender or a borrower or a tenant or a landlord, when I do the TBar, I learned TBars. It was the old Ben Franklin clothes I started using in 1978, 1979, where you put you put yes on one side, no on the other. Pete, I saw him modify this. I learned this from him in about 2000. This format, which was on the left side of the TBar, you put down the person's current position. What do they like? What's going on in their life right now? On the right-hand side, You put down their potential position. What can their life be like if they accept your offer? And so in this case, this landlord had gotten the house from his daughter, and she had walked away from it. The house was in his name, his mortgage, and by this time we were in a downturn. He had bought it in 2005, so this was around 2009 when he got the house back. The house had fallen below the loan amount, and he couldn't sell it. And so he's $25,000 upside down. And he had put a couple tenants in it because he had never taken David Tilney's class on landlording and master leasing. He didn't know how to be a landlord. So landlords aren't born, they're made. And he didn't know what to do. So the tenants ate his shorts, and he had gone through two tenants who had both done considerable damage to the house. And now he had just rehabbed it. So he rehabbed it after his daughter left. He rehabbed it after the first tenant. He rehabbed it after the second tenant. And that's where he stood. So he hated tenants, never wanted to see a tenant again. And he was upside down by $25,000. So the house, he owed $25,000 more than the house is worth. And it had $1,100 in negative cash flow, meaning the house was empty. His mortgage payment was $900 plus a month. But he was losing more than that because the utilities were owned. The grass had to be cut. He had to maintain the property. The insurance was higher because it was a vacant house. So he was losing $1,100 a month when I met him. And I asked him about doing a short sale or maybe giving the house back or let it go to foreclosure. And he didn't want to do that. He looked at me and he said, Bill, my dad taught me when you promise somebody something, follow through on that promise. And I promised the bank that I would pay this money back. And as long as I can, I'm going to make these monthly payments. So you're dealing with a very good man here. He has very good character. So I asked him, I said, well, can you bring $25,000 to the table and just sell the house? And that way it just goes away. And he didn't have the $25,000. And in the end, all he wanted to be done. And what he said to me is, Bill, I'll give you the property. I'll just take it. Just take over the mortgage, take over the mortgage payments, take this house from me. So if you ever wonder whether sellers will really give you the house, if you ever wonder whether sellers will ever do a substitute deal, which is you buy a house from someone, but instead of the seller's mortgage being paid off, you're agreeing to make their mortgage payments, own their mortgage for them until that mortgage is paid off according to the terms of their note. So this isn't a loan assumption. Their mortgage stays in their name. You're making their mortgage payments. If you ever wonder whether someone would do this, I didn't ask for this. This is what he wanted to do. Just take my home. Please make this go away. Now, the problem with this is he's $25,000 upside down, and he has $1,100 a month cash flow, negative cash flow. And write this down. This is an important lesson about real estate investing. It's okay to help someone out of the quicksand. It's not okay to take their place in the quicksand. And if I would have bought the house, if I would have, gone to closing and he would have deeded me the property, and if I would have agreed to a substitute deal, that was the wrong structure in this case because I was taking his place in the quicksand. It was going to be very dangerous for me if I did this. So that was not the best tool to have in your creative deal structuring toolbox. A substitute deal was not the best way to go. So when you're looking at what he could do, if he just accepted the offer I was going to come up with, I hadn't structured the offer out yet, but I knew I could structure something where he would have no more tenant headaches. Don't worry about being upside down. Don't worry about the negative cash flow. I may not be able to take care of the full loss of $1,100 a month, but I can help you lose less than you're losing right now. And he wouldn't have to do a short sale or bankruptcy or foreclosure. And he wouldn't have to worry about trying to come up with the cash to make up the difference if he sold the house. And the main thing is he would have no more worries about what's going on. He wouldn't have to worry about the problem of the house, even though he still owned it. He wouldn't have to worry about the house anymore. So here is the seller situation. The seller owed $95,000. The fair market value on this property was $70,000. So again, $15,000 upside down. His mortgage payment was $900 per month, and that's principal, interest, taxes, and insurance. But the house would only rent for $800 a month, so you had $100 negative cash flow. Now, most of us would never, ever take on this deal because if all you know how to do is a 70 cent on the dollar offer, you would have walked right past us. That's what Houston did in this case. He just looked and said, there's no equity, negative cash flow, upside down. He just walked away. But let's see whether it's a good deal or not. So here's the structure. First of all, we did something called a performance master lease. So I mentioned master lease. And again, David Tilney teaches this with his landlording course. But let me add in the word performance. All that means is that I am going to rent with a master lease. I'm going to rent the house from the owner. I become the owner's tenant. I'm not the owner's manager. I am not their property manager. I'm strictly a tenant, but I have the right to lease the property to someone else. This is also known as a sandwich lease or a wraparound lease. So that's a master lease. Now, what made a performance master lease is he agreed to accept $600 a month as rent payment for me. And I would pay him his rent only after my tenant paid me my rent. So that made this a very, very safe deal. So when I met the owner, he's losing $1,100 a month. Now, because his mortgage payment is $900 and I'm paying him $600, he'll only be losing $300 a month as long as my tenant pays me. But he doesn't have to worry about utility costs anymore. His insurance is going to come down some. He doesn't have to worry about cutting the grass anymore. So I'm taking some headaches off his shoulder by doing this. Also, by me stepping into his shoes and taking on his problems, then I also wanted a purchase option. But what that meant was sometime in the next 7 years, that's the timeline we agreed to, I had the right to buy his house. He couldn't sell the house to anybody else but me during those 7 years. And my mortgage balance, and this is what made this particular option so great, would be the then balance of the mortgage. You might want to write that down. So in other words, I didn't set a price to buy his house back. I set it to something, which was his mortgage balance. So every month he made a mortgage payment. What happened to the mortgage balance? It came down a little bit. So what happened to my purchase price? Every month he made a mortgage payment. It came down a little bit. So as time goes by, my purchase price for this home comes down, down, down. But remember, the property is going up in value. We were in 2011, 2012, so I knew we were dragging along the bottom, and I felt confident that over the next 7 years, we would see the value increase in this home. So my purchase price is going down every month, but as we start having appreciation of the property again, it would go up in value. So though there's no equity today, I felt confident that because I was capturing both the appreciation of the property and the amortization of the owner's loan, the equity would be created and continue to increase for the next bunch of years. Now, the owner's payments were very high, and we did a mortgage modification, much like you can do today because of COVID. But in this particular time, they had something called a HARP loan that doesn't exist anymore. But he agreed that he would go apply for a HARP and do a mortgage modification. Also, I noticed his insurance was too high, and that he would shop his insurance. He would take it to my insurance agent to get it shopped. And his property taxes had not come down from 2006 through 2011, 2012. They had not come down a dime, even though property values had plummeted, because he never filed his property taxes. And so I said, I will fight your property taxes, because he didn't know how. Here's how we funded this deal. First off, you notice I have no money out of pocket. So for those of you that say, I've got to have $100,000 in the bank or $500,000 in the bank to go do a deal, when you're doing a performance master lease and you're also getting an option to purchase, there's no need to take money out of pocket. You can't use the excuse of I don't have the money. That's why you're not doing deals, because you can do deals. And remember, because I'm getting an option to buy this property, an option is a right to buy, but not an obligation. So I never had to buy this property. He must sell to me. He's obligated, but I am not. I have the right to buy it. So the owner did do the HARP modification, and his principal and interest payment dropped from $755 to $540. And the insurance, because he went to my agent, it dropped from $1,005 down to $590. So that's significant. And I thought his property taxes, and they were cut from $700 per year down to $351 per year. So here's the result. When Houston and I pulled up into his driveway, when Houston said there's no deal here, You can't do anything here. He's upside down. There's no cash flow. We've wasted our time. This owner, within 3 months, when I met him, he was losing $1,100 per month, and now he's making $70 per month. Was this a big difference in this man's life? Yes, it was. Could I have done this deal if I did not have a performance master lease in my toolbox, deal structuring toolbox? I could not have. Would I have done this deal if I couldn't get an option? No, I could not have.
So Bill, before you go on, there was
Yeah,
a few questions
yeah.
that popped up. I think you're probably going to cover some of this, but we did have someone ask, how did you make sure that he couldn't sell it to anybody else but you? Did you cloud the title?
Yeah, I didn't cloud the title. The answer is yes, I clouded the title, but on the option that he gave me, I secured it to the property using something called, well, you can use a mortgage or you can use a deed of trust or a trust deed. So if you're in a judicial foreclosure state like you are in Florida, y'all use mortgages to secure promises to property. Now, here's the thing. For most investors, most realtors, most closing attorneys, they think a mortgage or a deed of trust in a non-judicial foreclosure state like Georgia can only be used to secure a promissory note. In other words, a loan of money. And that's not the case. That's not what mortgages do. Mortgages secure promises. So is a promissory note a promise? Yes, but so is an option. So is a purchase and sale. Anything can be a promise, and you can secure any promise to somebody's property. So by securing to the property, can he sell the house to someone else? Yes, but it's subject to my mortgage. My mortgage, which secures which is securing my option, is in the chain of title. So if someone does buy the house, they're buying it subject to my option. My option is still in place. I can still exercise the option. Just like if he got a loan from Bank of America and they had a mortgage on the house, could he sell his house to someone else? And the answer is yes, subject to the Bank of America mortgage. That still is senior to anything else. I'm going to use some phrases right now. I know I'm using phrases that may lose you. But again, in what I'm covering today, I'm just doing a tip of the iceberg about options. We'll cover this a lot more at the Power of Pure Options seminar in about 2 weeks. Another question, Larissa?
Yes. So another attendee asks, what happens if he struggles with the mortgage and then does have to stop paying?
Okay, so one of the things I have built into my mortgage, one of the things I have built into my options is let's say I have a 20-year option and I promise not to exercise that option for the first 10 years. Well, built into the option, it says if for some reason, for any reason, he gets behind on his mortgage payment, I can immediately exercise my option and buy the property subject to his mortgage. So I can turn this into a subject to deal. If he's not taking care of the property, if he's not maintaining the property, I can step in and immediately exercise my option and take the property subject to his mortgage. So let's say his mortgage balance is 270,000 on the house, and my strike price was 300,000. Then if I exercise my option, I would take over his $270,000 mortgage. It would be a subject to deal. So the mortgage is still his. I'm just agreeing to make the mortgage payments on his mortgage for him. And the $30,000 in equity, I would pay him at closing. So I don't have to come up with a full 300,000, just 30,000 of it.
We had two kind of questions. Yeah, they're kind of along the same lines, but how does this work at the top of the cycle? So probably, I guess, in today's market where we're still growing, how would this work? And then also, how does it work if the seller's not in a problem situation?
Okay, we're going to come back to a problem, not being in a problem situation. Okay, well, let's talk about that. Let's talk about someone who does not want to sell. So we'll talk about that in a minute. And
Okay.
it's on top of the market. One of the things that, again, going back to the lessons that Jack taught us, when you're in uncertain times, when you don't know where the top of the market is, you don't know when the turn's coming, what will interest rates and inflation do to the value of homes, and we don't know. We just switch from doing a warranty deed and being on a promissory note. We switch over to doing a master lease, usually a performance master lease with an option to purchase. And guess where my option purchase is held? In Advanta, in my solo 401k. Now that means I'm not going to manage the rental myself. I'll bring in a management company to do the management. I will not do the management myself. But the options, and most of the options Kim and I have, are held in retirement accounts. And you'll see why in just a minute. Another question, Larissa?
We had somebody ask about a HARP, but I think you mentioned that that was a specific strategy that was like in use during sort of like similar to how you could refinance because of COVID.
Yeah, and same thing. So they didn't have the COVID modifications back in 2008, 9, 10, 11, 12. And the HARP, I think it faded out somewhere around 2013, 2014 when the market came back. So you can't do a HARP modification anymore. It's gone.
Gotcha. Thanks, Bill.
But there's other modifications today you can use. People can still modify their notes, as we all know. I mean, it's being done all over the place right now. Okay, let's look at the exit strategy on this house. So we rented the house to a very good tenant because I'm good at tenants. I'm good at landlording. I've got a lot of experience. Again, David Tilney helped me with this. And we rented to a tenant for $800 per month. Remember, I'm paying the landlord, my landlord, who's the owner of the property, $600 per month. So that's working really good. Can you click for me, Larissa? I'm not able to. Oh, there it is. Okay. And so I'm making $200 a month in positive cash flow from this house. And I'm not at risk because I only pay the owner after I've been paid by my tenant. So there's no risk here. I'm also have an option to buy this house anytime in the next 7 years. So this was, as we come out, think of what the value of this property did over the next 7 years. And what I'm really able to capture here with this exit strategy is, as this loan pays down, I'm capturing all the amortization that the owner's paying. But also, as the property goes up in value, I'm going to capture all the appreciation of this property over the next 7 years. It made this a very safe deal because I would not exercise the option until I knew we had great value in the house when it was not upside down anymore. So with the Cox Farm, this case, what was the safer structure? And that's what I want you. This is what I want you to see. Yes, I could have bought the house. Yes, it was a subject to deal. Yes, the owner insisted I buy the house. Then the owner insisted I take his mortgage. But that was not nearly as safe because it was upside down, negative cash flow, and we were still in the Great Recession. So does it make sense that a better way to structure this deal because of uncertainty is to do a performance master lease with an option to buy? So those are the tools I used to get this. Now, in what we're talking about, when we're talking about pure options and master leasing and subject to deals and all the other tools out there, most investors have no clue. They have very few. They have one tool in the creative deal structuring toolbox, but here's why. Most people began investing in today's market after 2012. So all they've known is 10 years of rapid appreciation. All they've known is record low interest rates. All they've known is record housing prices that are going up month by month. All they've seen is record high rents that go up year by year by year. So in other words, you don't need to be a creative deal structurer. All you need to be able to, I did that wrong. But anyway, all you know how to do is use the big damn hammer. In other words, a 70 cents on the dollar minus expenses offer on a house. So in other words, you have to have a lot of equity in the house to be able to do the deal. But if you don't have that equity, if the owner doesn't want to sell, you're walking away from so many deals. Think of all the money you're spending on marketing, all the cards you're sending out, all the doors you're knocking on. Think of all that you're doing, and it's just too bad because there's so many of these deals that you're not doing because you can only focus on high equity deals. So remember that with an option, it's a right, not an obligation. And by that, what I mean is that with a bilateral contract, like a purchase and sale agreement that's been signed both the buyer and the seller, that the seller must sell and the buyer must buy. So that's a bilateral contract. But with a unilateral contract, can you click that for me, Larissa? I'm not seeing it. There it is again. Okay. With a unilateral contract, that means the seller must sell, but the buyer, because we're using an option, may buy So this is a simple case of must buy versus may buy. And when you're not on the hook, when you're not obligated to perform the purchase, it's a much safer strategy for you, especially in uncertain times. And I put down here Reynolds Bridge, but what I meant to say is on Cox Farm, was I ever obligated to buy this property? And the answer was no, I was not obligated. So if the economy didn't come back, the values didn't come back, I didn't have to buy the property. And so the market had continued crashing, have gotten worse. I wasn't on the hook. I wasn't going to be out any money. I was not on a note. I wasn't on the warranty deed. And with an option, when you think about Cox Farm, an option is not a loan of money. It's the same when I'm getting an option from a homeowner, as you're about to see. I'm acquiring something. It's not a loan of money. Their debt ratio did not go up. There are no monthly payments. There's no interest rates. So I'm purchasing an option, sometimes for money, sometimes for other things that they find a value. But it's just like if you bought their boat or you bought a car, you bought their hidden furniture. And because when I'm dealing with homeowners, I'm using options and not notes, then Dodd-Frank is not involved, because Dodd-Frank involves a loan of money. And I'm not. I'm purchasing an option from them. So completely different type of structure of deal structuring tools than what you're used to. So one of the questions Larissa asked me was, what would happen if someone is not motivated to sell? What if someone doesn't need to sell? I want to show you now a deal where the owner did not want to sell his home. He was being forced to, but didn't want to. So this deal was on William Street. And I'll show you the conversation I had with the owner. But this was a real simple case. The owner was on a fixed income, and values had gone up. This deal was done in 2020. So values had skyrocketed, insurance had skyrocketed, property taxes were killing him. And because he was on a fixed income, he was going to have to sell his home, though he did not want to. But he could no longer afford the home, mainly because the property taxes were eating him up. So watch what happened next. So I was out door knocking. So most of the deals that Kim and I do, they're found through door knocking. In fact, I'm getting ready to go make 1,000 written offers starting June the 1st, all from door knocking. So it could be from June the 1st to August 31st. I'll be making 1,000 written offers in a 5-mile circle around the Cartersville, Georgia Walmart. You can go to my website and watch, because I'm going to be taking a picture of every written offer I make and put it on my website. You can see what I'm doing, see where I am, see what the people are saying. I'll be doing videos as I go through the day. So if you want to know whether door knocking works, or can you find deals in this economy, will master leasing work? Will people agree to options? You can just follow along and watch what I do during the 1,000 written offers. So in this case, when I knocked on this person's home, the approach I used was, I just liked the neighborhood, and I said, I love your home, I love your street. Kim and I want to own a home here. Do you know of anybody thinking of selling? And the man on the porch said, yeah, me. I'm going to have to sell. I'm being forced to sell pretty soon. Now, the way he said it, he was kind of bitter about it. You could hear that tone in his voice. So I asked the question, why? Why are you having to sell? And he said, because I can't afford the property taxes anymore. And I said, well, it sounds like you really don't want to sell. He goes, I don't want to sell. My wife and I love this home. We don't want to sell, but we can't afford it anymore. We're going to have to sell. And then I asked him a very simple question. I said, listen, would you trade me a glass of sweet tea if I can show you how you never had to pay property taxes ever again? Would that be of interest to you? And of course, he's being forced to sell his house, so he's willing to listen to anything. So we went in, I got my glass of sweet tea, we sat at the kitchen table, and I want to show you the structure that we came up with that gave him what he wanted. So again, here's the TBar. Current position is he doesn't want to sell right now. His property taxes are too high. He's going to be forced to sell. He doesn't know how to fight his property taxes. So you just saw how I fought property taxes on Cox Farm. And because I'm good at fighting property taxes, here we are again. And he just doesn't want to move. He said, we want to be here for at least 10 years. No, I don't want to sell. And so if he accepted my offer that I was going to structure out, then he wouldn't have to sell right now. And I could help him lower his property taxes. And I've been fighting property taxes for 16 years successfully. And here's the big one. He never had to pay property taxes ever again, ever. And if he doesn't want to move, he doesn't have to move. All he has to do is accept my offer. So his choice is very simple. Current position, he's going to sell his home and move from it. Potential position, accept my offer, never pay property taxes again, stay in your home. This is a pretty easy decision for most people. And so here's the structure. I asked him, what did he think his house is worth? And he said about $175,000. And I said, okay, I'm going to fight your property taxes for you because I think your property taxes are way high. And I said, the other thing we're going to do is from now on, I'm going to pay your property taxes. I'll pay your property taxes. You never have another property tax bill again. And in exchange, what I want you to do is give me a 30-year option, 30 years with a right to buy the house for the current fair market value of 175. That's all he has to do. So all the appreciation he's collected on this house up to this point is his. But any appreciation, any growth in the value of home above 175, I get to keep. But also, I said, so my strike price, my purchase price for this home over the next 30 years will be 175. But I also said for every dollar I pay in property taxes, the strike price, my purchase price would be reduced by $1.50. So in other words, I'm making a 50% return on my money for every dollar I spend on his property taxes. And I also said, even though we'll be holding a 30-year option secured to the property using a mortgage or using a deed of trust in Georgia, that I would not exercise for the first 10 years unless he moved from the property, unless he decided it was time to leave the property. Then I would go ahead and exercise the option immediately, but I would not exercise for at least 10 years. And so what you're looking at, this is just a little bit of the option agreement. And if you want to know, because option agreements come in many forms and sizes, there's many different things that need to be in an option agreement based on what you're doing with it. So it's not like a fill in the blank form. So in this case, on this option agreement, I want to make sure I can be found. So this is recorded in the courthouse and my phone number and address are on it. So in case he goes to sell it, in case he goes to refinance it, whoever is doing the title search will be able to find me easily. And one other thing I want you to see, so again, tip of the iceberg stuff, is people always think option consideration must be cash. Well, it doesn't have to be cash. In this case, I'm agreeing to pay his property taxes each year. That was the consideration. That's what he found of great value. That's what was going to allow him to keep his house. So with William Street, this was known as something called a strategic option. Strategic options are very long-term tools to use. So I use this when the owner doesn't want to sell right now. He wants to keep his house. And for us, again, this is a long-term hold strategy. This is perfect when I'm using my self-directed retirement accounts. So when I have my Advanta solo 401k, don't you see that the thing that's to be paying the property taxes for this owner every year will be coming from my self-directed 401k? And the options be held by my custodian, which is Advanta. So all the growth one day when I exercise my option, if I choose to exercise the option, would be coming into my solo 401k. And this is the type of structure that almost nobody knows how to do. And again, it's because he did not want to sell. There's an easy solution to the problem as long as you understood how to use a pure option. And I did not look at him and use something called a buyback option. I'm not going to go into a lot of explanation here of what a buyback option is, but I did not give him the right to buy my option back. I had the option to buy his house, and that was going to stick, and it was going to stick for 30 years. And might the owner come to me one day and say, I would like to buy the option back? Yeah, he might come ask that, and we'll discuss it then, but I don't discuss this ahead of time because I don't want this to look like a disguised loan. In other words, where I fall back under Dodd-Frank. So we do not discuss upfront buyback options. Again, but sometimes owners do come back to me and say, listen, I've decided not to sell my house. And then we have the discussion of, might I sell my option back to the owner? I could sell my option to anybody I want to. So who will give you a strategic option, this long-term option like this? And this is someone who needs cash. And this is where I use this is where this is This is the area where most of my option work is done. The things you're about to see, this is who I find, and this is who I'm doing option work with. So in this case, someone who needs cash but just doesn't want to sell. So maybe they need money for something. Instead of selling their car or selling their boat, might they sell me an option to buy their house? The answer is yes. What if someone needs to have a roof repaired, or they need to have their air conditioner replaced, but they can't afford to do it? What if I put a new roof on their house or put a new air conditioning system in their house in exchange for the right to buy their house one day in the future? In other words, the option. What happens if someone, their appliances are broken? They don't have a dishwasher, they don't have a washing machine, their stove doesn't work. Might they trade an option for the appliances? I hit home runs here, and you saw that with Cox Farm. Landlords who hate tenants. So I will take on the management of the property using a master lease, but I also want the right to buy their house at some point in the future. When I've sold houses before to an investor, and I'm right now talking to all the people who've been doing all this flipping, all the wholesalers out there. Did you ever stop to think of, let's say you have, because right now it's really hard to find property. So if you're a wholesaler and you come across a home run deal and you're going to put it on the market for someone to buy, a lot of times people bid that up, right? But what if in addition you said, listen, I will sell you this contract, or I'll sell you this property, but you're going to give me an option for part of the upside, part of the appreciation, part of the equity in the home when you sell it. What if you had been doing pure options all this time on all those contracts that you flipped? What would those options be valued at today? How much have you walked away from over the years? And don't feel bad. I'm going to show you where I just lost $217,300 because I didn't do a pure option. So hang on to your hats on that one. So also, when a homeowner wants to buy a home they can't afford, in other words, I'm able to sell a home to them for well below market, but in return, I'm able to buy that home back for them over a period of time for the same price that they paid me. So let's say a house is worth $500,000 and I sell it to them for $300,000, but I have the right to buy it back for $300,000 in the next 30 years. So I can capture the appreciation on that property. And oftentimes I'm going to come across a seller who's trying to get their house sold, but it's in bad condition. So, and this is being known as a tactical option. But what if I agreed to fix up their house, and then we were going to sell the property, and I had an option on the property to split the equity in the house when the property got sold. And again, these options are being held by my Advanta account. So this is some information about my class coming up. It's going to be on May 21st and 22nd. It's going to be in Tampa, Florida. We're going to be at the Marriott on West Shore Boulevard. This is going to be one of the most comprehensive options courses in the country. And to me, right now, it is the most comprehensive options course in the country. And I've been doing option work for 20 years. I learned from Jack Miller and Pete Fortunato. And normally this course is going for $647, but through Sunday night, for people who are on this call and listen to it, we've discounted the price to $597. So you would sign up by going to our website at billandkimcook.com and use the coupon code Advanta, and we'll lower the cost of the seminar from $647 down to $597. Now, there are different types of options. So we talked about a strategic option, that's a long-term hold, but there's also tactical options. We talked about that just for a minute ago. But that's a owner who doesn't want their property anymore. They want to sell. And that was kind of like Cox Farm. So in other words, they want out pretty quick. We call that a tactical option. You also have something called a magic option. And I want you to be careful of these because I've heard these talked about where, let's say you can get an option on a property on the first of the month, and then the option gets paid off, and that option makes $100,000 at the end of the month. And let's say that option was in your Advanta account, your retirement account, your self-directed account. Don't do that. It's okay to do something like this outside the thing. Go and pay the taxes on it, but don't do this inside your IRA. It's just too dangerous. There's something called a buyback option, which just means if I sell someone a property, I have an option to buy back that property at some point in the future. And I'm careful not to use buyback options with a homeowner, a civilian, because then it can look like a disguised loan. We talked about that a little bit earlier too. I use right of first refusal options all the time. And all that means is if someone goes to sell a house or someone goes to sell a note that I've given them, that I have the right to step into their buyer's shoes and do the deal. So again, a real simple thing that should be in a lot of your contracts. Extension options. So let's say someone came to me and said, "Hey, Bill, we want a 3-year balloon in the note that we're going to give you, that you're giving us." I say, "Okay, I'll give you balloons are dangerous, but I'll give you a balloon in the note. However," and this is where the extension comes in, "I want to have the right to extend the balloon an additional 3 years by paying you $1,000 to be applied toward the principal. I get to do that 4 times." Do you see all of a sudden that balloon is not nearly as dangerous because you can extend the balloon out a number of years to make sure that when you do pay off the balloon, it's in a really good market, not when times are pretty, tight. I also use options, and I'll discuss this a good bit at the course, but I can use an option that's going to be secured to one of my properties to help protect it from lawsuits. Again, I'm not going to go into a lot of detail about that here. And I want to finish up with this last deal, which is where I failed to use an option and I lost $217,000. So if you've ever lost money investing, watch this one. It's all because I didn't use a pure option. So how this deal was found was this property was going into foreclosure on March 11th. And the borrower owed $120,000. We couldn't find the borrower. We knew the fair market value of the property was $85,000. So again, upside down. The repairs the house needed were $8,300. And Kim worked with the lender, sending them information so they understood they were going to have an opening bid of $120,000, which is what the borrower owed. And she helped them understand that that is not what the house is worth. She sent them information so they understood the fair market value was $85,000, but it needs some work. And so the lender, their opening bid dropped to 57. It was right around $57,000 opening bid. We didn't know the exact number, but that was the number that they told us where they'd start. And for Kim and me, we wanted to keep this house as one of our rentals. It was a great home. It's in our little town of Adairsville where we live, and we wanted to keep this. So at the same time I found this deal, a friend of mine, we'll call her KK, was going through a divorce. She had 2 kids, and she needed a new home to go to, and she could only afford an $80,000 mortgage. And so this property would be perfect for KK. So Kim and I, we were able to work with the lender to have that opening bid reduced. And KK didn't know how to buy a property at a foreclosure auction, so we were there with her. We walked her through the deal. We were at the auction with her. And so she was top bidder, and she bought this property for $57,700. Look at that beautiful home. Look at what she paid for it. Now, she got a heck of a deal, right? Now, because she was a friend of mine, I did not ask to get a pure option. But what if, let's play what if for a second. What if I had gotten a pure option? What if I had the right to buy this property anytime in the next 30 years for the $57,700 she was able to buy the property for? Today, that current market value on that home is $275,000. In other words, when you do the math, by not getting a pure option on this property, I gave up $217,300 in growth. Now, what could I do with this option today? I could have sold it. I could have exercised it. There's lots I can do with it. And your question would be, why would KK ever give you an option to buy this when she bought this property? The answer is she had a real simple, she had a simple choice. She could have rented the property from me. I could have not sold her the home. She could have not gotten a mortgage on the home. And her mortgage payments would be much higher today because those rents on a house like that today are $2,000 a month. But what she pays for the home is her mortgage payment, which is now more than halfway paid. And the mortgage payment is like $400 a month, and that's it. So yes, of course she would have given me an option because it was a great deal for her. But again, because I didn't, this cost me $217,000. And to see the video on this, where I'm standing in front of this house, I just shot this video. You can go to Bill and Kim Cook, where I talked about this deal in detail. So again, if the power of options, if this options talk that I've given, if this is making you scratch your head and saying, I want to learn more about this, I want to know how to use options, I want to know how to use pure options, come take our class. Again, you can go to Bill and Kim Cook for full information. And if you do decide to come, make sure you use the code word Advanta. So I want to thank Larissa for having me here. I'm happy to answer any questions. This is my contact information. If you want to call me, you're welcome to. That's my phone number. So Larissa, all you.
Yep. Thank you, Bill. Yep, we do have a few questions. And guys, I know we're right at 1 o'clock, so please feel free to stay on with us as Bill answers these questions. So we did have a question about what happens if the seller, when you go to exercise your option, have you experienced a seller refusing to sell?
Okay, I've not had that happen to me, but let's say they do. So because the option, the promise, is secured with a mortgage or a deed of trust, think of it this way. Let's say you went and borrowed money from Bank of America, and let's say it's $200,000, and then you decided sometime down the line you just didn't want to pay on the mortgage anymore. You've changed your mind, and you decide not to pay the lender anymore. The lender has, because of the security deed, because of the mortgage, the lender has the ability to call that note due, call that promise due. And then if you still don't pay it off, then the lender can foreclose and take the property via foreclosure. Same thing with this option. If they decide not to sell me the property, they make that choice, my backup is to call the option due and then take the property foreclosure, and I'll take the property that way.
Okay. Next, we had a question about tax benefits. Are there any tax benefits when using an option because you have income and probably some expenses? Are there any tax write-offs?
This is where Advanta comes in. So if my option is held in my retirement account, if Advanta is my custodian, so let's say that option gets exercised and it realizes a $100,000 profit, then that means $100,000 is going into my self-directed solo 401k account with a Roth component, no taxes. Mm-hmm. Now, if I do it outside my retirement account, yes, but if you hold the option for less than a year, that's considered short-term capital gains, not earned income. If you hold it for over a year, that's considered long-term capital gains. So with the option work, because it's an investment, it's not considered earned income like you would have with a flip.
Okay. I don't see any other questions. If we'll give you just a second to ask any last minute questions here, but Bill's contact information is on the screen so you can reach out to him. And of course, check out registering for his class by visiting his website, billandkimcook.com. You can get all the information for the class right there at billandkimcook.com. Also, again, just as a reminder, you guys, the slides are attached as a PDF to the navigation bar. So if you go to the right-hand navigation and click on handouts, you'll see it there so you can download that. I don't see anyone else putting questions into the chat box, so we're going to close the webinar now. It is recorded and will be available for viewing again. It'll be emailed to everybody that registered, and Bill, I will also share the recording with you as soon as it's available. And thank you so much for joining us today.
Larissa, thank you. And again, for all you do for the real estate investing community. Kim and I think the absolute world of you and your family and all the sacrifices you make and all the help that you give. We're just greatly appreciative for you. Thank you.
Oh, thank you so much, Bill. And somebody did have a question for you, Bill. Is your class going to be available online?
Yes, what we're going to do is we will record the class. And so it will be a home study thing. So it comes with a comprehensive manual, all the documents that I use. Again, I don't have a option document. I have lots of options documents depending on what I'm trying to capture, what I'm trying to do. But yes, it will be online. You'll be able to purchase it on the website. Another thing, what I'm thinking about on the website is I do a lot of interviews with experienced investors, with the legends of real estate, and also I've just started a new category of young investors under 21 years old. So I just put up an interview with a young girl. Her name's Mackenzie. She's 16 years old and she's working on her third deal. And her teacher at school told her that she can't own real estate because she's not 18 years old. So Kenzie looked at her and said, "Should I give the properties back?" But go look at those interviews because they're really good. They're insightful, especially that one if you have someone young at home.
Great. Thank you so much, Bill. And so check out his website. And again, he did say it would be available, excuse me, as a study at home course. So you can check that out and reach out to Bill with any questions. And with that, we'll close the webinar and we look forward to seeing everybody. I'll be at Bill's class. So if anybody is going to be there, I look forward to seeing you. And thank you so much, Bill.
Thank you so much, Larissa.
Take care. Bye-bye.